Hey guys, what's up? So in today's video, I want to talk about the global depression. This was something being talked about a lot in March and April when the health crisis first struck. Since then, we haven't heard this term being thrown around much, but I want to play a clip from Ray Dalio. Now, if you don't know who Ray Dalio is, he's an American billionaire hedge fund manager who served as co-chief investment officer of Bridgewater Associates since 1985. Basically, this guy knows money. He's really well respected in the investment community. So I want to play a clip of him talking about the global depression, and then after the clip, I'm going to give you guys a few tips on how you can safely invest in the current state of the economy.
You think that we're headed into a global depression?
Yes, but I want to be careful about what I use the word, like to be
Right,
technical.
absolutely.
The word is an evocative word, and
Sure.
it can be scary and so on. So what do you mean by a depression? Okay. Something like happened in the 1930s. So just to repeat, 1929 to 1932, there was a fall in the economy and a very double-digit unemployment rates and a magnitude of fall in the economy like about 10%. Do I think we're in that? Yes. How was that dealt with? 1933. What they did is they printed a lot of money. And the government came out with the same type of programs that we're having now. Yes, okay, same thing. Zero interest rates hit zero, same thing. Okay, same dynamics. And then there is that money causes an expansion from that point. How long does it take for the stock market to exceed its highs? Or how long does it take for the economy to exceed its former highs? A long time. Okay, do I think that's what we're in? Yes, that's what we're in. We've seen that happen repeatedly in history. So many, many times. It's just the most recent one. And there's a structure to that. So yes, this is not a recession. This is a breakdown, an operation that I'm just describing in terms of how it's dealt with, the production of money and credit, and all of that. That's what we're in.
And so you've talked about there's sort of four levers to recovery after a depression: cutting spending, also known as austerity, debt restructuring or forgiveness, redistribution of wealth through taxes potentially, and printing of money. Some of these things you've mentioned. Will those things get us out of this situation, since, as you feel it's happened before? But how would you think about balancing these tools right now?
Yeah, those are the tools since eternity, basically, since recorded history. Those are the ones that operated. And I think what you're going to see is a combination you're seeing of printing money and redistribution. And I think it'll last. These things happen pretty quickly. They last maybe a couple of 3 years in terms of that process. And then you have a rebuilding, and they're dealt with creativity. The greatest force through time is inventiveness, human inventiveness, adaptability. So you're going to see these restructurings happen, and you're going to see the kind of inventiveness that you just saw from Marco, okay? And it's the power of that adaptation that is the greatest power. I did a study, which is on LinkedIn if anyone wants to see it. And it goes back 500 years. And it shows real GDP. In other words, the economic activity going back there. And there's a line. And you don't see these depressions, as we're calling them, even on that line. They barely wiggles. When you go into it and you look at that piece, that's what it looks like. GDP falls 10%, unemployment goes up, and it passes. And because the greatest force is the force of adaptation and inventiveness if we can operate well together. So that's what I think it's going to look like over this period of time. It'll pass. The world will be very different. There'll be a new world order. But it will pass and we'll be inventive, because what we're dealing with now is just money and credit. Money and credit is just digital. I mean, there is real goods, services, those are real. But everything else is just accounting. And so when you change the digits and you work those things out and you work yourself through, that takes, a couple of years at most, kind of. And then you come back into a restructured environment. And it could be said that it is really healthy in many ways because it is a stress test. Because if you look at history, people have gotten, sometimes they get weaker or they're not prepared to, in many ways. Weaker in terms of maybe they don't build enough savings and they operate that, or maybe they emphasize luxuries over necessities. It's a reorienting type of experience that in many ways makes us healthy, even appreciating the basics of life.
Okay, so basically Ray Dalio says we are in a depression. Now, I happen to actually agree with this. I don't think most people realize how bad the state of the economy is. So let's talk about this. But first, let's see what a depression is. So the last Great Depression was in the 1930s. It began around 1929. The duration of it was about 43 months. As you can see here, the global GDP declined 26%. Peak global unemployment, 24%. So this kind of sounds like what we're going through today. Now, if I left this video at just that, most beginner investors would probably sell all their stocks and just hold all their money in cash and gold and anything safe. And if we were in 1930, that is probably something I'd be doing as well. But in today's environment, it is so much different than in the 1930s. You see, we live in the digital age with technology and the internet. That is truly the big difference. Because if we ignore the internet and look at the brick and mortar businesses that we have, they're actually being affected very similar to how 1930 was affecting them. As you can see here, this is a list of 21 companies that have all gone bankrupt since March. I mean, just look through this list. Tailored Brands, GNC, Tuesday Morning, JCPenney. Like, these are massive companies. Pier 1, all gone bankrupt. And this list is continuing to grow. But it's not only the big businesses that are gone under. It's small businesses. This says here, small businesses are dying by the thousands and no one is tracking the carnage. I think people are truly just ignoring what's actually going on in the economy today. I saw a statistic that in Canada, 60% of small businesses are expected to go under. I think the majority of them are in the small business restaurant sector. Restaurants is just absolutely a massacre right now for them. So it's really not looking good, but again, this is just kind of being ignored right now, I feel like. So yeah, we have small businesses and big businesses all going bankrupt. We have the real estate that's looking really rocky, and once the stimulus slows down and the mortgage deferrals go away, I mean, you never know. We could also see a massive real estate collapse. I wouldn't count that out right now, but there is light at the end of the tunnel. Right now, there's actually amazing investment opportunities. You just need to know where to find them. But first, let me show you a little statistic about the S&P 500. So the average lifespan of a company listed in the S&P 500 was 61 years in 1958. Today, it's less than 18 years. And McKinsey believes that in 2027, 75% of the companies currently quoted on the S&P 500 will have disappeared. That is insane. Why isn't people talking about that? Let me explain to you why this is occurring. It's because technology and disruptive innovation. Half of the companies in the S&P 500 are doing extremely poorly and they're being disrupted and losing business to these other technologies. This is why I really don't suggest investing in the S&P 500. You're investing into a pool of companies that are half doing good, half doing bad. I mean, I'm pretty sure most of us can do better stock picking than that. So yeah, really just times have changed in the S&P 500 and the total landscape of investing has changed a lot over the last 100 years. Okay, so just to recap that, small businesses are going under, big businesses are going under. Companies in the S&P 500 don't last nearly as long as they used to because they're being disrupted by technologies. So right now as investors, you really gotta think about what you're investing in and if it's future-proof. Is it being disrupted or is it disrupting industry? That is something you need to take into consideration. So over the last 6 months, we've seen tech stocks perform amazingly. And I don't think this is gonna stop in the next few years anytime soon. There might be the odd correction pullback because they get ahead of themselves, that's normal, but they are gonna continue to be strong. So in my opinion, if you're looking to invest in something, I would personally avoid the S&P 500 for now, and I'd be looking at something more like ARK Invest. ARK Invest solely invests in disruptive innovation, and they're very good at it. I really suggest you guys researching this company. I have a few videos put out on them on my channel, so please check them out. I break down what ARK Invest is, and in my opinion, they're probably the best ETF you could be looking at right now. But if you're not interested in investing in an ETF, and you're more into investing in individual stocks, well, I do have some sectors that I believe are gonna continue to perform very well. Because let's be honest, right now, there's not a lot of places where people can spend their money. You can't go to sporting games anymore, concerts are done, nightclubs aren't really a thing. People still dine out a little bit. There's really not much reason to buy fancy clothes because where are you gonna go out with them? I mean, yes, people still go to dinner, but I mean, there's just a lot less opportunity to dress up and to go places. So in a lot of different areas, people just aren't spending how they used to. But the funny thing is, people are saving at higher rates than they have in the last like 20 plus years. Probably because of the stimulus checks and there's just not a lot of places to spend money. So let me show you where people are spending money. So it's a very strong stay-at-home environment now. So as an investor, we should be looking at places like Netflix, Disney Plus, video games, cannabis, alcohol, and different food companies such as Costco and Walmart and other ones as well. So let me just break down why I picked these. So Netflix and Disney Plus, these are just streaming services in general. Since there's no more movie theaters you can go to, people still want to watch TV and watch movies. The really only option is streaming services. So I'd be looking there for sure. And then video games is pretty self-explanatory. People are staying home, people don't have as much entertainment, so more people get into video games. That's gonna continue to do well as well. Well, food, well, that's just essential. People always need to buy food. They always will. And because there's less people eating out and more people eating at home, that's why Costco and Walmart have been performing so well. They're gonna thrive in this environment. And I mean, they probably continue will. It's a pretty safe spot to put your money. And then when we look at cannabis and alcohol, well, I mean, these are just things that people will love in any environment. That's why I really like the cannabis space actually, is because it's really hard to disrupt. It's a product that people are always going to love. And in the current health crisis, it's gonna thrive. And even without the health crisis, it's gonna thrive. In 2018, we saw a massive cannabis bubble that bursted. And I think it really scared a lot of investors away because they lost a ton of money. But the bubble has bursted and now we see what companies are actually strong and moving forward out of it. So yeah guys, that's all I have for this video. I hope you found it informative and I hope that this changes your thought process on how you're looking at stocks right now. I'm sure a lot of you already are thinking this way, but maybe not everybody is. And it's important to really take a lot more into consideration right now than you ever have in your investing career. So yeah, if you learned anything, please drop a thumbs up on the video. It helps out the channel a ton and it gives me the motivation to continue to do these videos. And feel free to subscribe if you want to see more stock related content. And yeah guys, I'll see you in the next one.
Mm-hmm.